Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today, well, with HDFC Bank ruling the roost yet again in terms of points contribution, we ask whether banks and the rally that they're giving helps the markets navigate through the pre-results volatility and build on to that on the post side. In fact, whether BFSI will stage a post-polls rally as well might depend largely on what the private banks do as well. So that's something that we focus on. And amongst everything else that's happening within autos, auto ancillaries and pharmaceuticals, the other one pocket that has stood out, I mean, we talk about the micro, and one of the micros that we'll talk about today with Aniruddha Sarkar, our guest, is whether the scorching heat thus far will aid the summer stocks in the quarter gone by, and will that help portfolios make money off some of these. So let's get him in. He's the CIO and portfolio manager at Quest Investment Advisors. Joins us right now on the show. Aniruddha, great having you. Thanks for taking the time out. I hope all is well.
Yeah, hi Niraj, good morning. Yes, I think everyone is waiting for the results in a week's time now.
Yeah, but the markets have staged a bit of a pullback from those 22,000 odd levels, Aniruddha. So is this a part of the pre-election rally, or did a large part of what happened last week have to do with what the RBI did?
See, I think Niraj, basically what is happening is the market is kind of, depending on what comes from the different phase, like, we have the elections phased out over the 6-7 phases. And I think market is being a bit worried between the numbers which the ruling government will get. And I think that is what is leading to the FIs exiting in huge numbers. We look at the FI numbers for the whole month of May, I think it has been one of the highest exit numbers. The recent rally, I would say, to a large extent is some amount of the FI money coming back. We saw massive up move on the Nifty within a day when we saw the FI numbers, which were very, very positive. So I would say it is more about the pre-election optimism mixed with the pessimism, which is leading to the sharp movements in the market. RBI, I think to some extent definitely is also going to, I would say, has been contributing with the huge number of the dividend which they have given to the government. I think that also is a big factor, which is kind of increasing the optimism in the market.
Okay. So, Aniruddha, my question to you is, are you fully invested currently, or are you waiting for the verdict to be out? And for some people, they're saying that just looking at the valuations, even so, if the verdict is of policy continuity, if the market rewards that and bumps up further from where we are right now, that might be a valuation level where you should be careful. Even if you don't lighten up your positions, might be difficult to make a case for further building of positions. I'm trying to understand how you think about this whole thing.
Yeah, I think as an investor or as a portfolio manager, I think as of now, I'm keeping around 8 to 10% cash. It's not that I'm very negative on the outcome or on the market, but I think, as you rightly mentioned, the valuations are something which is not giving you many investable ideas at this point of time. Having said that, I would say that something like, the markets, if they give you a kind of sharp up move around the time when the election results happen, I think it would be a good time to take some profits off the counters where the valuations have become very expensive. Now, I would say that it's not that everything is expensive. I think post the election results being out, I think the whole discussion would go back to sectors, companies, and the valuations, where earnings growth is there, where valuations are comfortable. That is where the money will start flowing. Definitely looking for ideas in this type of market where everything is quoting at very, very high valuations, both on an absolute basis and on a relative basis, is something. Keeping 8-10% cash is not a bad idea.
Okay, so that's the first aspect. Yeah, I'm interested in knowing this. You're talking about how valuations in a few pockets are looking expensive, right? Aniruddha, the likes of Cochin Shipyard, Garden Ridge Shipbuilders, HAL, etc., they are throwing up phenomenal results, but the gains have been terrific too. So I'm sure valuations are high. What does one, did you have exposure to these stocks? And if you did, how you think about them in light of the fact that they've run up so much, but they're posting results which are very, very strong? What do you do?
No, I think that's a very big, I would say, big issue with, being a value investor and looking at the numbers also every quarter, which they've been coming up. So I have been an early investor in some of the defense companies, but I would say looking at the numbers where the stocks have zoomed in the last 1 year, I would say that, I exited a bit early. But having said that, it's very difficult to justify the valuations at which most of these defense PSU companies are. So definitely the numbers are coming excellently well, but I think most of the next 4 to 8 quarters have already been priced in. Now, that is where I would say is a big concern, that what is priced in and what the market is not pricing in. Now, the big issue is that many of these companies are under-owned also in many of the portfolios. And when you see the numbers coming from these companies and compared to other pockets which were typically overweight in the portfolios, which are not reporting good set of numbers, that is where I would say the investors are having a big issue to decide that do you continue holding the companies which have historically been a large part of your portfolio and the numbers are not coming so good, compared to those companies where valuations are looking rich, like the defense PSUs, but numbers are coming extremely well. You keep hearing about the order books. You keep hearing about the type of opportunity which is coming for Indian defense companies. So I think that is where is a big kind of a confusion of both portfolio managers and investors alike.
Okay, so yeah, well,
But to be honest, I would be kind of, it's not that I would be completely away from it. I would say that, we need to be in some companies where the growth looks very strong, where I would say that the replacement or rather the alternative opportunities are not there. Like, some good companies in the capital goods companies, some good companies in the defense companies, where I would say there are no alternatives. And these companies might continue to trade at a high valuation for a long time. So some amount of allocation can be done there, but I wouldn't say it should be a very large part of your portfolio.
so let's assume. I mean, you're of course not at a. We're not asking for a buy sell recommendation. I'm just using these stocks as an illustration. If that's, I mean, a lot of people talk about the ABBs and the Siemens and maybe the Cummins, etc., or what have you. That spate having a moat around their the expertise that they bring to the table. You think that if a business or if a company has that kind of moat, then they might continue to trade at these quote unquote egregious valuations?
Absolutely. I think, companies like which you mentioned, and also along with that, there are many other MNC companies which are there in that whole capital goods and engineering space, where I would say that historically they have always quoted at anywhere between 40 to 60p when I look at, 1 year forward or 2 years forward. Compared to that 60p, some of them are quoting at 70, 80p. Now, the issue is that, historically they have not shown this type of a growth. And so I would say that historic 40, 60p is now the new 60, 80p. So that is, I would say, the valuation shift which has happened. We can't compare this 80p with the broader index because historically they have always quoted at a high valuation. Now, these high valuations come from the fact that, they have a strong parentage, they have a strong, I would say, the R&D expertise which they bring on the table. And in fact, there are some companies who are the only suppliers of a particular type of a product in the market, and demand for those products are going up. So I think, you will find these MNC capital goods companies, energy EPC companies doing exceptionally well. Valuation is a big question that, is 60 the right multiple or 80 or 100? But I think as long as the growth continues to do better than what they have been done in the past, I think they will continue to quote at a high multiple.
Got it. Okay. That's well noted as well. The other aspect is, Aniruddha, what's happening to PSU or what could happen to PSU banks, for example, post this whole RBI dividend. And the dividend, a lot of people believe, will bring down yields. Not that we've seen tremendous movement in yields per se, but this JP Morgan bond inclusion sometime in June might also have that impact on bond markets. And that to a few people means that there will be MTM gains in PSU bank's portfolio. The results haven't been too bad either. Are you constructive on that bucket?
Yeah, I think PSU banks have definitely come of age, since those days wherein, they used to be the hated lot. And I think what we have seen over the last 24 to 36 months is a massive kind of the multiple gap between private and PSU decreasing drastically, wherein on one end you had the private banks quoting at 4 price to book and you had the PSUs quoting at 0.5 price to book. I think that massive valuation gap has decreased. Having said that, I would say that where they stand today, I would say PSU banks continue to do well, both on a operation front and also on the valuation front. I think they are not expensive. Along with that, I would also say that, some of the private banks, which have seen a massive multiple contraction, I think they are at those levels where valuations now are getting into that zone wherein you don't mind allocating some money to the private banks also. I would say from here on, both PSU and private should do well. Overall, banking sector valuation is looking attractive considering they have underperformed for the last 1 year. I think, so in my portfolio, I have decent allocation to PSU banks also.
Okay, and watch out for those PSU banks too. And then let's focus on consumption for a bit. Let me start off by getting my colleague Harsh, who speaks about this Jeffries note on GMR airports, because it's got a tinge of both the infra play as well as consumption here. Harsh, good morning. Can you tell us what this note suggests on GMR airports?
Well, yes, also a little bit of value unlocking, if I may add to that.
Sure.
Niraj, with regard to all the land banks that they have and all the real estate that they own. But absolutely right, just in terms of numbers, over the next 5 years, Jeffries is expecting a 3x in terms of EBITDA coming in for GMR airports. Target price being 100, let me put that out of the way, 15% upside from here. But just for more context in terms of the business itself, GMR airports nearly 25+% in terms of passenger traffic market share in India. They operate both Delhi as well as Hyderabad, with good expansion plans on both those airports in the pipeline, and therefore that could also be a positive. The other positive is, of course, the entire duty-free opportunity which some of these airports have, and as you correctly mentioned, Niraj, the consumption play as a result of just having yourself in a business with that kind of a footprint where you have 25+% of passenger traffic access to some of these duty-free shops and the like. And that entire play is yet to fully play out as per Jeffries. In fact, to a large part yet to play out. And therefore, that opportunity size is fairly large. Of course, with the kind of EBITDA numbers that are expected, profit should be right around the corner. Jeffries is expecting FY26 to be the profitable year or the start of profitability, and therefore quite bullish. They've initiated coverage on this one, and hence this one is in focus.
Well, thanks for that, Harsh. Thanks for bringing us those details. Aniruddha, could you come in on something, I mean, of this nature, wherein the beliefs are that, let's say, for example, one brokerage believes that EBITDA could be 3x in 5 years, and these are plays on the urban spend or the high-end consumption pockets. Now, for the last 2 years, we've seen stocks benefit from this urban high-end consumption spend. Will these kind of stocks continue to do well on urban spending, or is it time for a change of guard wherein the rural spending focused companies could come to the fore?
Yeah, so like talking about urban consumption, I think, it's a very interesting part because it's very close to my heart. And I have been bullish on this whole urban consumption theme for the last almost 8 quarters. And almost 40% of my portfolio is allocated into urban consumption. Now, the idea of being bullish on this urban consumption, and I would say that this is one part I continue to be bullish even now. The reason being very simple. This whole urban consumers, I would say the demand and income has been very, very strong. It has been resilient to whatever has been happening in Europe, America, agri side not doing well. This urban consumer is one part where the demand and the income growth has been very, very strong. Now, the idea of being bullish on this urban consumer, and as an investor, what needs to be seen is that where do people like you and me, we spend our money? And as you mentioned about the airports, I think the holidays is a large part, both for business and for the leisure. So I think this whole aviation part, along with airports, is definitely going to continue to be a good kind of a growth story. Along with that, I would say hotels, which we have been very bullish on, continues to do very well. I would say along with that, the consumer discretionary, basically, where do we spend our money? Eating out, going out to the malls, the movies. I think this is where a lot of growth is going to be there. We have been negative on the whole agri consumption for almost last 8 quarters. I've been bullish on urban consumption, but I would say in this quarter, we are seeing some signs of the revival of agri demand. And if, as per the IMD, if the monsoons remain good this year, I think we should see the agri side of our economy also picking up on the demand side. We have seen the bikes and the scooters demand doing very well. I think the other consumer discretionary FMCG companies should also start reporting a good set of numbers. We have seen the margins improving there, but I think the volume growth is the real thing which I'll be looking out for.
Okay, watch out for volume growth. Watch out. So that's Aniruddha's take, of course. Watch out for GMR in particular. If you believe the Jeffries note, we of course have this piece by Harsh done in detail, and it'll be there on our social media handles as well. Can't not talk about the other aspect of banks. We spoke about PSU banks, but private banks. And the last 3 days, Aniruddha, the private banks have just started to come to the party. Now, we know that relatively, the bank nifty is not been right up there in terms of performance in the recent past. What's in store over the next 12 months? The valuations are not exactly very, very expensive relative to India's own historical private banking valuations. But a lot of skeptics say that corporates don't now only have to resort to private banks for their credit needs. It's happening through multiple ways, and for credit growth of banks will not necessarily be equal to the kind of capex growth that India does. So why should I buy into banks? How are you looking at this?
No, I think I agree with your point, which you mentioned about these experts, with regard to what historically valuations in Indian private banks used to be there. I think that was kind of an aberration. And I think that was the period when it was kind of a very high growth phase wherein you didn't have multiple options of getting the funding from. Having said that, I think those old multiples of which the private banks used to enjoy, it might be a kind of the thing of the past, and you might not see those multiples coming back. Having said that, I would say within the private banks, you had the pecking order completely reversed. Like there used to be a time wherein on the valuation front, you had the Kotak, HDFC, Axis, and ICICI. The entire pecking order has turned upside down. So I would say there could be within the private banks, there could be some amount of the catching up of the ones which are better valued, because I think some of the concerns which was there with some of these private banks, they have been addressed to a large extent, and now the management has also understood that what needs to be the focus area with regard to the growth versus the profitability. So I think you could see some amount of catch up happening within the private banks, but I would say it should not be a discussion between private versus PSU, because both will go hand in hand. Having said that, as you rightly mentioned, there are many good NBFCs which are being very active these days with regard to the lending. But I think RBI has been trying to keep a tight leash on the unsecured lending to ensure that you don't have too much of the underlying asset risk. In fact, just recently RBI came out with a guideline for the banks to ensure that NBFCs who are kind of doing the co-lending with them, they should try to assess the risk of the underlying assets over there. So I think eventually we will see some sort of a control even on the NBFC lending, and that needs to be at par with what the bank will be doing.
Okay. The other aspect is pharmaceuticals, and I just want to take a moment before I go ask Aniruddha about the pharma results to just highlight what's happened today, for example, in terms of the performance that some of the companies have given. So Divi's, very strong performance, and the company is also guided to a decent growth number for FY25 and capex continuation. And the commentary, of course, includes some plants, etc., that come on stream in FY27, if I'm not wrong, or FY26, belonging to large multinational contracts and all of that. Similarly, Glenmark Pharma, exceptional balance sheet strength shown by the company, current versus what happened 1 year ago. And the numbers have been okay. EBITDA was up 26%, so it didn't look too bad. We saw decent performance from Torrent. And I thought decent performance from Oro as well, just that the stock hasn't quite reacted that way. So a clutch of these pharma names have actually given some fairly decent quarterly performance to end the year. And the commentary from a clutch of those isn't that bad either. Aniruddha, do you track healthcare closely? And would love to understand the first aspect of healthcare, pharma, be it US generics, be it India exposed companies, be it CDMO companies. Do you like any of these? Why or why not?
Yeah, I would say, after almost 18 months of being negative on pharma, over the last 6 months, we have been adding some of the pharma companies. And I think the rationale for that was exactly what we are seeing in this quarter in most of the pharma companies, is that there would be a massive improvement in the margins. And margin improvement is what is getting reflected in the numbers, if you see. And this is mainly because the raw material prices have improved. They were at very high levels. That has gone down drastically. Several of the investments which they had done in the new markets, those markets are now yielding results. if you look at the kind of the growth which has happened, not just in America or domestic, even the rest of the world market, I think that is where again the growth is coming from. Also, there are in some cases, different companies wherein the new launches are also contributing, which was all in kind of, you can say, the capex mode for the last 1.5 years, wherein all those things are now yielding. So I would say the pharma space, both CDMO and the generics, is what we are betting on. And valuation along with margin improvement is what is the main factor, because I think this whole space had underperformed the market massively. You saw massive contraction in multiples in all these I would say the pharma companies. At the same time, margin improvement drastically along with top line growth is aiding a bottom line growth at a much faster pace, and I think the valuations will start looking much better.
Okay, and just moving beyond there, diagnostics, hospitals, I thought the numbers were very strong. Fortis, some of the diagnostic companies, Metropolis, etc. Not bad. Do you like this bucket, or are there better places in the market?
See, as a concept, definitely I like hospitals because, it's a underpenetrated market when it comes to India. We need multiple more hospitals compared to what we have today. Only thing what keeps me away from hospitals is the valuations. And I think if I have to look at the end of the day that, between the number of stocks which are there in the market, I have to pick up only a handful of them. So the hospital does not become the top pecking order to enter the portfolio, mainly because of the valuations. But I would say it's a concept where they will continue to do well. Only issue there is that whenever the realizations go higher, government control might come in place. Same thing what we saw in case of the I would say the diagnostics, wherein the government control of the pricing happened, and that also kind of sometimes hurts your valuations. So I think both diagnostic and hospital, they are good as I would say the concept stock, but valuations will keep me away.
Okay, I have one final question, Aniruddha. I heard you say that you fight 10% in cash. I would love to know, will the deployment of cash be dependent on the markets correcting a bit and valuations becoming reasonable? And if so, what are the pockets that you've shortlisted that you might deploy this capital in?
See, the whole idea of keeping that 8-10% cash is that, in case around the election results, we see some kind of the wild swings in the market, because we don't know, elections can always give you a very big surprise, both on the positive and on the negative side. So I would say that depending on how, the outcome happens and depending on how the markets move, idea is to get deployed into some of, I would say the cyclical companies, because I think the whole power EPC space, energy space, power space is where I would say we are evaluating a couple of names, and that is one area where I would say we are very bullish, considering the type of power demand which the country is seeing and which will see in the next 5-10 years. So this whole power sector, the whole value chain of power sector is what I'm looking to add in the portfolio.
Got it. Okay. We will watch out, and that's a pocket that's actually had a good run to viewers, so keep that in mind. I think in some sense it's been a rank wealth creator for the current calendar, arguably for the last 12 months. And just looking at the plans that India has in terms of power creation, I think multiple facets of the value chain of this pocket could well be in for some very strong earnings growth over the next 3-4 years. Valuations, as I think Aniruddha said, is everybody's individual call. Some people might be happy paying top dollar. Some might be waiting for a better chance to buy in. Aniruddha, great having you. Thank you so much for taking the time out and speaking to us today.
Always a pleasure. Have a good day.
Thank you so much to you too. That's the view from Quest. And with that, it's a wrap on this edition of Talking Point. Thanks so much for tuning in.